is a little differently than other places do. The simple reason is we're looking for any like expansion or contraction volatility in general. I was a market maker for 15 years. I've been with market option pit for 7 years. We run a small fund, Carmeline Capital, and but volatility trading is one of the things is what we do. And we took market maker techniques and have tried to translate it into retail style trading, right? So we might as well get going. Here's our disclaimer. The educational material presented here is for informational purpose only. Trading options at your own risk. Consult your financial advisor. Options are risky. Be very careful. Okay. So what we'll do is, what is an iron butterfly today? Butterfly conditions, just understanding kind of how Black-Scholes works in the Greeks. We'll talk about skew and strike, and then how edge hunters use to look for something and why you want to look for it. That's the important thing. There's always like a why, and then trying to create some kind of a trade plan around it. I do some mentoring around the sheets because mostly people see them and they're like, okay, how do you use them? So part of this is helping people learn how to use them to identify certain things. Okay. So again, starting from this, literally is gonna. This is such a dense amount of material. You're gonna go from what's a butterfly to how to use volatility to put on a fly using a sheet, all in one class. Which, you know, I'm going to say it's not a small amount of stuff to learn. Okay. So usually an iron butterfly, it's a straddle that is hedged. So probably one of the most important things about trading butterflies is the looking at the strike you want to sell and expecting things to compress to that strike. Okay, so if you put on a butterfly and you don't expect the market or the underlying to compress to the short strike, you're going to have trouble. All right, so that basically, you try to take out most of the directional risk, which will take out quite a bit of it. Statistically speaking anyway, although not all of it for sure. You're trying to get out the as much as you can. You're selling at the money or near the money call spreads and selling at the money or near the money put spread at the same time. Okay, and what it does is it creates a tightly risk-defined high yield area for a fly. So you're basically selling two spreads against each other. An iron condor sells two spreads wide, and an iron butterfly sells two spreads very close together. Okay. So a delta neutral butterfly, you know, what does it look like? So in the case here, I'm selling a 2370 strike, and then I'm buying the 2390 and the 2350. So there's a couple things here from a note point of view. You know, I would say that are, excuse me, semi-important, is we would call this a 20-point fly. Oh, you got a ton of people in the other link, the one that was emailed. Oh, so we have people in the wrong class? We have two links that went out? Okay, hold on. I'm just going to pause. Thank you, Howard. Don't know how that happened. All right. Let's see here. What we're going to do is, so what I was pointing out about a butterfly or near delta neutral butterfly is, let's get some drawn stuff up here. We got the telestrator going. Okay. Is just a couple of notes as we go forward, right? So one is, what I'll note is this is the short area of the fly. You're selling some sort of straddle. So what some of you might have missed, you know, we had some of you that have just got in here later, is if you're selling a fly, right? What do you want to have happen, by the way? Or if you're trading a butterfly and you sell a couple strikes, what do you want to have happen, right? You want the underlying to go where? To the short strike. It's not as little as possible necessarily, Mike, depending. But little as possible is fine. But you want to move to the short strike. So when you put on a fly, a delta neutral fly, you have some conception that the underlying has to move somewhere. Does that make sense to everybody? You got to get to this point where you have this, you know, the very top of the hat for risk. All right. And Mike's question was, I just assumed you'd be starting at the midpoint. Well, that's what you're going to see about this strategy is starting at the midpoint is not the priority. Okay. What's very important is that when you set up a trade, when you set up an option trade, don't you think it's important to have an idea of what you think the underlying is going to do? Right? So you want to make sure that the trade you put on reflects what you think could happen. And if something else happens, then you have risk control and you manage what you try to fix what you got, right? But first off, for putting the trade on, this webinar is going to focus on why do you want to look at a certain thing, okay? So here you have a fly that's, you want to sell the 2370 strike. The two wings of this fly are 20 points out. It's a 20-point fly, and you want it to stay in a range somewhere around 2370 is ideal. Okay, so that's an ideal situation for this fly. Okay, so the concept, if you have a butterfly on like this, is you have flatter deltas or not as many. It's not really a money maker. You have short gamma, short vega, long theta. Okay, so if you're used to having delta as a money maker, you know, how many people buy calls and watch the stock go up, or they sell puts and they watch them go out worthless, right? The idea of a delta neutral fly or a low delta fly is you're looking for other things to make you money. Okay, other things have to happen in order for the fly to perform. So what I want to do with this webinar and why these sheets were developed, and mostly they're developed through client requests. Like, so our whole Edge Hunter suite was developed because one of my students 3 years ago, or one even 3 or 4 years ago, like, I want a sheet that helps me find butterflies, or I want a sheet that helps me find time space. And I sat and helped them make them. Right? They did the sheet programming, and I helped them with kind of the methodology. So when you were a liquidity provider, like I was for a long time, most of my adult life anyway, is you always had some kind of theoretical value to work from. So the concept behind here is you're trying to understand what that theoretical value means and how you use it. So what I try to do with teaching people how to trade options is you start focusing on the Greeks that you're looking for, right? So if you're not trading a delta, what are the other Greeks that could potentially make you money, right? There's gamma, there's Vega, and there's decay. So if you can't make money from one Greek, you're trying to figure out how to make money from the other Greeks. Okay. Now, what I would do here, I would add a couple things to the butterfly, right? Somebody mentioned, excuse me, somebody mentioned that you don't want the underlying to move too fast. Okay, so right there, you're looking for a reduction in realized vol, meaning the underlying is not going to move as much as the market thinks. So how many people, if you put on a butterfly or an iron condor and you lose money right away? How many, has that ever happened to anybody before? All right. Okay, I want to raise my hand. I've had to chase more short gamma trades than probably anybody, right? So when that happens, I just want you to get a sense of this. That pretty much means the vol assumption you made when you put it on is what? Is dead wrong. So you have to think of, okay, well, I'm wrong. And then you want to fix that. Now, we're really not going to go into trade management here in this class because we don't really have the time. But we want to focus on how to build your fly, right, to give you the best chance to make money. So if you think about it, when you look at a fly, right? If we look back at this, what are your moving parts on this fly? And we have a question, do I leg into it sometimes? No, I don't. You could possibly leg out of it or adjust it, Mike, but if you leg into it, it's, I would leg into other types of trades like vol pairs and stuff, I think are much easier. But a fly can get away from you so fast. You know, you do the long leg and then the short leg just gets away and you're screwed. So personally, that's not something I like to leg. Because it just adds a level of complexity, right? So one thing when you're looking at a fly, right, do you see how you have the 2350 strike, 2370 strike, and 2390 strike? Okay, what I want you to keep in mind in your head is all of those strikes have unique volatilities. Okay, so here in this example, what I want you to see is there's a volatility of 2411 here. Actually, scratch that. That's the delta. 823. Hold on, let me get my little spotlighter. Okay, we have a vol there, 823. We have a vol there at 896. We have a vol there at 960. I'm sorry, whoops. Okay. Where is my, I didn't do the wrong one there. Okay, so I've got a vol there, a vol there, I have a vol there, and I have a vol there. So I got 10.5, 870, and 823. I have different vols for different strikes. Now, here, do you guys see this green line that's very, very steep? This is basically just showing you what all the different volatilities per strike is on this curve, right? Now, what's one thing you notice about this line? Doesn't that line look kind of straight? I mean, considering there's what, 60 or 70 strikes, doesn't it look like it has a slope? I mean, I know we're going back to, you know, high school algebra with y equals mx plus b. Actually, this is more like about a parabola, but you get the idea. It's a line with a slope, right? Now, here's the next thing. Do you think that the market created this exact slope? Like all of the buying and selling has somehow created a magically straight line for the vol curve of a butterfly. Take a guess. Bo says, that's amazing. How did that happen, right? So the idea of this vol curve is, and this is a what I would call kind of a, this is a very steep sort of blown up example. But what happens with these curves is if the market decides to sell puts in the SPX, what do you think happens to this curve from the at the money? It does that. Do you guys see that? And if the market decides to sell out of the money calls from the at the money, the calls go down. If the market decides to buy a lot of calls, the curve goes up. If the market decides that, this is actually a pretty steep curve, by the way. If the market decides to buy tons more puts, the curve does that. What the liquidity providers have figured out is they keep things in a nice, and I traded the SPX for a while, in a nice straight line. And all that happens is these lines move back and forth. Can you guys kind of understand that a little bit? I know you weren't SPX traders, but the way vol curves work is that there's a math to the curve, and all it is changing slopes. But can you see you can have almost an infinite number of changes, combinations? You've got your at the money move, your upside calls moving up and down, your upside puts moving up and down. So what you have is you have a dynamic shift of one strike in relation to another. So do you see how a volatility of one strike can move relative to the volatility of another strike? Does everybody kind of get that as a, what I would say is as a concept, right? You can, like Michael S is saying, is this a steep skew? This green line would be very steep, yes. Yes, this is a steep skew in this example. Because the other examples I'm going to show you are not that steep. But what I'm trying to get you to understand is your strike, which is right here, can have different vols. The x-axis is very tight on the scale. It is. It is. We're going to loosen it up a little bit. But to illustrate the example, things can move. Now, normally you would say, if you sell puts, let's say you just sell puts, right? Do you really care how much the skew moves if you just sell a bunch of puts? I mean, you care, but the put you sold is not against anything. When you trade a butterfly, aren't you buying two tail options against options you sell in the middle? If you think about it. So if these options are moving a certain way on the tail and your straddle is moving a certain way a little differently, would that impact the value of the butterfly that you put on? Yeah. And it could be to a fairly large degree. So what you want to know is there a time where it's better for me to make this trade based on how these curves are moving around? Because what is the liquidity provider, the guys that trade on the floor that rob you of all your dollars, right? What are they responding to, you know, on an hourly basis, minute by minute, depends how busy it is? What are they just responding to? Just supply and demand. Okay. What is the only advantage that the retail trader has? Okay, and it's a real advantage. You're nimble, but you can pick your entry. Very good, Alan. You can pick your entry. So would it make sense to try to wait, if you're going to trade a butterfly, this type of trade, to look for the best entry that you could get? So what that does is that sets up for us a time or some timing that would help us for a trade. See, didn't you know how exciting trading butterflies could be? There's all kinds of excitement, like, you know, politics, global events, nothing compared to trading butterflies. So remember, like what Black-Scholes wants is one forward vol to expiration. So I just drew you guys this curve, right? Like this, right? What is Black-Scholes? What's the curve of Black-Scholes look like on a volatility curve? One flat line. So what do you think this skew curve is going to do as you get toward expiration? What should be the natural movement of volatility as you move toward expiration? Right? All these puts start to melt as a function, and all these calls start to come up as a function. The closer you get to expiration, the more active this action becomes, right? Because what happens is your Vega per contract gets smaller and smaller and smaller. Your volatility per contract gets smaller as you get close to expiration. So what that does is that creates a window for us to put on a type of butterfly. So the option market gives us skew to adjust some of the central assumptions of Black-Scholes. Okay. So the two assumptions that skew overcomes is the increasing forward underlying value, one, okay, and the annual volatility assumption in the model, right? What the skew does is it adjusts for outlying events and the fact that the market tends to go down a lot faster than it goes up. It goes up over a long period of time, but that doesn't matter if there's a tweet on China and we're down like 2% tomorrow. So the market preloads bad news and it discounts a rise. So what this will create for us is just the opportunity to sell relatively expensive options, and then we just manage the Greeks. Okay, so now we're going to look at, like, okay, how do we do that? How do we go about that process? Okay. How do we use the information on skew to our advantage? Oops. Okay. So the key is vol per strike. Now this is live vol. It's a good volatility tool. It's the one we use a lot. And you have an implied volatility per strike. So every strike has a unique vol. It also has a decay per strike. So that's $87 a day for a one lot. And your Vega per contract is $124, meaning If the vol goes up 1 point, that contract gains $124. If the volatility goes down 1 point, the contract loses $124. This also means that your option is decaying at $87 per day, $87.85. Okay. The gamma in the contract means that the underlying moves a buck, SPX moves $1, your delta changes by $1.42. So you go from 52.58 to 54. Okay. So volatility per strike just means every strike has a vol. Every vol has a set of Greeks that are unique to it. So if you think about it, if you have a butterfly, right, you have kind of moving parts, don't you? So if I have my butterfly where I'm short this stuff, right? So I've sold this strike and I'm buying this strike, right? What if the volatility goes up in this strike and goes down in this strike? Would that mean your butterfly is performing faster than the Greeks actually describe? So remember, I have a Greek risk here that I have a net Greek risk for my fly. But what does that assume, right? What does Black-Scholes assume, right? That everything is moving at what? Right? If vol goes up 1 point, oh, it's just going up the same all the way across the curve. But I just showed you from that diagram that it's not necessarily how volatility works. Right? What happens is all of those curves move and inflect around the at the money. Okay? So if you can set up something to help identify this, you might have a shot. Again, anytime you can find any edge in the market to give you a head start, that's really what you want, right? So to use our sheets, this is the reason that we have them. We're looking for the chance where it's most likely that this long vol will go up and this short vol will go down to help a butterfly trade perform. All right. So now really it's just a game of arithmetic to try to figure all this stuff out. Right? And that's what the sheets, you know, computer programs, like a friend of our CTO guy says, they're there to do like all the computational stuff that you don't want to do. Right? The heavy lifting of all the computation, among other things. Right? So now the idea of trading for edge is you have options. You're trying to sell one volatility for a higher value than another. So when I started as a liquidity provider, I used to have sheets, which were very new back in the late 80s. And the deal was you had these sheets and you were trying to just buy options that were cheaper than the value and sell options above, all around Black-Scholes and a volatility. And if you can do that time and time again, you should make money. So the ideal here is the same, right? Even though there is a skew in the options, what happens is the skew just doesn't disappear and go to zero and flat tomorrow. The skew will slowly do this, right? Right? It will get steeper in time. So here's your curve, right? And you just saw that really steep one like this. But the difference is that as you move through time, the dollar amounts for the volatilities get smaller and smaller and smaller. So there's an area for these flies that basically, you know, that gives you a pretty decent window to operate them. Okay. Those will be right around 1 to 2 weeks. So in our example, we had flies with each strike has a vol, right? So we got that vol, and that vol. So all we want to do is just rationalize the one volatility against the other. Sum them up and see what we get, okay? So we'll buy vol on the long strike and we'll sell vol on the short strike. And let's see what we get. Okay. So if I do a standard calculation here, if I buy one contract here and I buy one contract here and I sell two contracts there, I'm just weighting the prices and getting an average here. So I'm spending more vol than I'm selling, right? So I've got 1046 plus 823. I divide by 2, that's 1869, right? And I divide by 2, that's 934. 934 is more than 897. So these wings, when you average the price of the wings out, it's more than the internal. So what's happening is your vol that you're buying looks like this. Right? So if you're drawing a picture of this fly, you're buying this wing here, which is slightly more expensive. You're selling something here and then buying something there, right? So if I take this chunk and this chunk, I'm spending more on this than the stuff I'm getting in the middle. So what's happening is, if you make that trade, your options are going to decay less fast than normal because you're buying an overly expensive option. Right? The biggest thing about having your vol net is that you want your trade that you put on to start to decay right away. Right? To let the natural action of options actually work. Okay. So what happens is the 37.37 vol points translates into $46 in lost money for the trade. So since you put on something for negative edge, you can just think that that's theta dollars you're never going to get. So if you're expecting $87.85 on total theta for the day, you basically put on a trade, and half the day you're not collecting any decay. So you put on a trade where you've got to spend half the day before you even can start making any money. Now, doesn't that sound kind of weird? So if you bought a call, it's just kind of like buying a call, and you have to wait till the stock moved $2, right, or $1 before your call made any money. Would you make that trade if you knew if that was the reason for it? Or I should say, would you make that trade if you knew you had to give up a half a day before your contract actually had a shot to make any money? Would anybody want to do that? Say, I'm going to buy a call this morning, but I have no shot to make any money on it till noon. Right? Or I'm going to sell this put this morning, but I know it really can't possibly decay until noon. Nobody would do that if they knew better, right? So here's another question. Have you ever put on option trades where you think something's going to happen, yet the option is not behaving the way it's supposed to? You're looking at it and you're like, this should be moving in this direction. And you're like, why the hell is this happening? Okay, that's mostly because you either got the vol direction massively wrong, or you put on a trade with negative edge to begin with, so it can't start making you money yet. Does that make sense? So the one thing about options is usually all the reasons are something relatively simply mathematical. Okay, so the idea of these sheets are to help you get in front of the math. Right? It's hard enough to try to make money trading options. Market makers front running my idea. Now, when people say market makers front running my idea, I totally get that. But believe me, there's so much paper coming in and out. Oh no, I know, Mike P, but it sounds funny. I like it, right? And there were times, believe me, when paper would come to the floor, And, you know, and we could tell because they keep sending the broker back to do stuff. Like they're trying to fool us, you know. Like we're sitting there and this guy's trying to buy 1,000 contracts or something and he's trying to be clever. And we're like, yeah, we are going to try to screw this guy. And now another comment here is Petru is saying, sometimes trades make money faster and more than expected, right? So there has to be, and that is correct. So that means there has to be something in the trade that the Greeks can't measure. Does that make sense to everybody? The Greeks can measure a lot, but they don't, like those first order Greeks, don't measure everything, right? They don't measure everything. The Greeks really can't measure skew or the way options move against each other, right? Trust me, I learned that the hard way, very early. There's nothing like being short, you know, 300 or 400 or 1,000 deltas in the SPX. It goes down 20 points and you don't make any money. You're like, what the hell just happened to me? Okay, that's my earliest recollection of how skew works. Short 500 deltas, SPX is down, I don't know, 20 bucks, didn't make any money. Actually lost money. But you'll see the reason a little bit. So what you're trying to do is, when you're looking at volatility and where things can go. So what's important when you're looking at flies and volatility, right, is where this IV can go when you're trying to put the trade on. So you have to have a bit of a sense, because a butterfly is very much a vol trade, of where the vol can go, right? Can it go up? Can it move down, right? But for a butterfly, because it's a spread, right? So one of the things with a spread trade is, so if I ask you this question, is there kind of a, let's just call it a theoretical limit where how one option can move against another option? Or do you think they can just move, you know, infinitely apart in any way possible? Nobody likes that question. So what I would say is options, when you put on a spread, once you put that spread on, the relationship is joined. Okay, exactly. There has to be some correlation there. They're stuck together. They're going to move around each other because one option cannot get infinitely cheaper than another option, right? Because what would you do? You would buy the option for 0 and you'd sell the option that has value, right? Like, how can I lose? So there's a limit to how much those options are going to move against each other, right? So if I asked you, if you bought a butterfly for $0, would you do it? Yeah, right? Can't lose. That means what you're selling the guts for is the same price as you're paying for the wings. You can't possibly lose. That means either your wings are too cheap that you get to buy, or your guts are relatively expensive. Do you guys understand that? So when you start to look at something like that, that means one option can be moving a little bit out of whack versus another option. And doesn't that just sound like the skew curve kind of moving up and down depending on what the market's doing? That action. Okay. So all this SPX chart is basically says vol can go down, right? So if you're looking for a butterfly, most of the time, is this going to be a great time to trade a butterfly when the vol is down there? So that red line is 30-day volatility, right? Can you expect a lot of compression from volatility when it's already at the bottom? Not really. Okay. Part of this strategy is you need volatility to expand a little bit before it can do what? Right. It has to expand before it can contract. Okay. We have a really good butterfly trader at Option Pit. He's excellent. We always know that the market's going to start to turn around when he starts coming back to put on a couple of flies. Because Vol had already had him. When he, Vol flies and then things kind of level out a little bit, and it's like perfect time for a fly, and then he shows up to put a couple on for him. He trades for a couple days, then he leaves. It's fun. Like, oh, it's got to be it. All right. Now, here is what the curve looks like for real, right? So this is a product that we developed, Edge Hunter. All it's showing is the slope of the curve in real time. It updates every, I think, 15 minutes, which for the SPX is enough. It might even be every 5 minutes. So what you have is you have the closing curve is this black line, right? You have the orange curve is the current record, and the blue curve is the first record of the day. So if you think about it, okay, vol opens here or closed there. The vol moved, opened at that blue line, and then it spent the rest of the day doing what? Going up a little, right? Do you guys see that? So volatility closed on the black line, opens on the blue line, and then rises a little bit. Now, would you say that rise in volatility is pretty equal across the curve from the blue line to the orange line when you see it like this? The blue line is the first sample. The blue line is the first printed sample of the day. And then the rest of the day, it's spent going from the blue line up to the orange line. So what I would say is the market's opinion on volatility is doing what? Right? It started a little lower. Possible they lowered the vol a little too aggressively or whoever, right? And then you spend the rest of the day with the vol going up. So if you're putting on a butterfly, do you want to put it on that dead morning when they just crash the vol right away? Or do you want to wait till what, right? Something is happening that might make you interested. Okay? Vol's moving up to that orange line. Okay, so this is an example of vol moving in a real way. So Alan, the black line is the prior day's close. You open blue line and it drifts up to the orange line. Better wait for a vol spike. So now what you want to do is what I'm trying to get you here is now you see that these curves move a little bit. And now you have to evaluate this curve. Does that make sense? You have a curve, you've got vol, you know these things move, but now how do you evaluate it? Okay. Okay, here are my tricks. You ready? This is what my time in the SPX taught me. Okay, so this is the tricky slide. Okay, is when the index rallies hard, so we're going to start at the black line, okay? So that's where, let's call it, that's the close of the day before. If the index rallies really hard, what happens is, because it rallies so hard so fast, it creates a huge gap from where we open to where we are. And that pulls all the vols up from the bottom. So this line will steepen a little bit on a heavy rally. So therefore, a lot of these butterflies set up very well after a large rally, creating what I would say is a downside fly. The opposite happens when you have a sell-off, where we start at the black line and the next move is here. Let me erase clearly, right? So our first line was here, right? Where they're lifting up all this stuff, which will make a certain types of flies more favorable. When the market sells off, all this juice, because what happens is, think about it. If the market rips down, do you think the liquidity provider wants to let all those upside calls go to zero? Right? So the market was just there, and those calls were $10. You think they're going to let them go all the way down to $1? So what happens is the volatility on that part of the curve is naturally going to rise. This stuff will get more expensive when the market starts to fall. What happens now is a fly pointing to the upside, where basically you think of it this way: your short end of your fly is just above the money on this one, and the short end of your fly on your green line is just below the money here. That helps you set them up. Like I said, we're not going into like heavy implementation strategy here. What I'm trying to give you is like what I would call a broad stroke. When do you want to look for these things? Essentially, you want to start looking for flies. We're starting to set up for them once the market has moved more than the implied volatility at the money says it's supposed to. Okay. The at the money's right there. At the money's right there in the middle. Okay. So so this, what I would say is, as with strike, we're looking for edge in our IV, so we'll talk about that in a second. In a downward butterfly, you want declining implied vol. You want realized volatility to be declining, right? No fly is going to make money if you blow outside of the wings. Now, you can set up flies that are very stable, that hold out pretty well, even though you go outside of the wings. We're not going to get hugely into that in this one because we only have a few minutes left. But the idea is declining realized vol over your whole time is optimal. So if you think the market's still moving or going to keep moving, fly is your last choice. Okay? It's just the wrong trade because it's not how it's going to perform the best. Okay. Now, what is Edge Hunter? Okay. What it does is it's taking the market data and just rearranging it based on a trade, based on what they're giving you, okay, for a trade. So lucky for us, we have a pro chat room. A lot of my students are in there. Many of them use these sheets. And some of the guys are like, hey, look at this fly, because I'm looking at these two. I pull up a sheet, I go, oh, okay, this doesn't look too bad, right? Now, all of that doesn't mean anything to you, but I'm going to explain why, okay? So here, there's three things that are important on the sheets. One is the ratio of the options. Two is where are the strikes here. Three is what's the edge that we get in the trade. And then four is the calculated risk reward we get for the trade. Okay. So in this particular case, this fly was called a 132 fly, and I'll explain it in a second. The strikes here were the 29.30, 29.70, 29.90, which actually works out to a risk-controlled debit fly. The edge I got for this trade was so basically negative edge means you're selling more than you're buying. What I've found in a fly like this is the most you normally will get for positive edge, which is a negative number. I know that's confusing, but your negative number will usually be about 100 basis points. That's about as far as a fly will go before it becomes an arbitrage opportunity. So this at 0.38 isn't as far as it could go, and it could go a little farther. But what that means is when you put it on, you're starting the clock running in the right direction. Now down here, this actually tells you so the cost of this fly was $5.90. Potential gain of 34.10. That's if everything happens perfectly by expiration. Your risk reward is like almost 6 to 1. Which it doesn't sound too bad, right? So this fly at the time, this was Monday, we were trading right around 29.90, maybe like 29.95, I think. This was the 29.90, 29.70, 29.30 fly where it's basically an iron butterfly. You sell 2 call spreads and you sell 1 put spread. I'll show it to you in a second. And this was basically what this sheet is doing is it's calculating all of the flies in this specific term and allows you to compare them one to another. So the edge in this fly was 38 cents, the edge in this fly was 14 cents, the edge in this fly was 56 cents, the edge in this fly was 3 cents. Okay. Now, the thing is, why did I pick this particular fly? Okay, for an instance. So at the beginning of class, what did I tell you if you put on an option trade, what you have to have? Okay, you have to have some idea where you think things are going, right? So at the time, like, well, you know, I just don't think we're getting over 3,000. It's going to be hard. So what it is, I set a long leg at 3,000, but things didn't look too good. So I put what I would call the risk leg down to 29.30. So I was looking for the fly to slide somewhere between 29.90 and 29.30 SPX. I wasn't pointing it on the upside. I really wanted to make money on the downside. Okay, that's the direction I was in. So the user actually, Alan, the question is, does the user input stuff? This generates the optimum fly from all the strikes. So what it does is it just tests all the strikes and gives you the best ones. And then you can decide where you want to aim it. That's how the sheet works. So when I show you like the full sheet, okay. And we do have one for toss, and I'm pretty sure it's working. If you're interested in it, let me know and we'll work something out. It's not as robust as this sheet, so we wouldn't charge as much for it. But what happened is it has every strike. So what this is doing is giving you all the standard flies, and then it is giving you the fly with the best edge here in the middle. And then it's showing you more flies and seeing how the edge starts to radiate out. Now, you can expand the strike width. You can move the short end manually as well. Right? And then this goes all the way out. Now, there's other features to it and stuff, but this is basically, now, here's the important thing about this sheet. Okay, so when you're looking at this fly, do you see how you have this positive edge number? So that means you're buying the 29.90, you're buying the 29.30, and selling the 29.70. Do you guys understand that part? All I'm doing is reading this: long 2, short 3, long 1. So what that means is that the market is pricing this 29.70 strike slightly higher than everything else. Do you guys get that part? So the important thing is the market is pricing these puts that were below the market higher. So you're putting on a trade and liquidity providers are bidding those puts up. You know, either they want to buy them back, or to me, that's kind of like a target for where things can go. Now, when you're looking at a fly, the good thing about a fly is since you're long this strike and short that strike, it sets up the right way, right? Because anytime you put on a spread, you want to go from the long strike to the short strike. The times where you would manually input a strike is when you don't like the results that you see and you want to move farther out of the money. So here was a fly. So remember here, this trade was a $34.10 credit to put on this iron butterfly. So here's some notes, right? So this is kind of like the intelligence of the sheets. You know, what ratio generates your risk reward? So back here, this is a $40 fly that costs you $34.10, so you're only risking $5.90 on the fly. Pretty good risk reward. Okay, bid strike, meaning you were trying to identify where the expensive strike is, which is generally the stuff the sheet is telling you to sell. The edge is when things turn green, blinky green, like hey. And then the risk reward is how much do I make per dollar risk? So what you're trying to do is you're trying to analyze your fly right away. We used to call this the skewulator, you know. So this Alan said this very well. The sheet is identifying trades with edge, and you see if any of them fit your outlook. That is correct. Okay, and I think I have here. So this is how this fly ended up a couple days later, right? The market basically, it dropped, I think like 20 points, right? 20 points on the delta should have been worth about 300 bucks. The fly actually did better than that in a day. It was up like 500 or 600 bucks in a day. Because what happened is you had like several things kind of happening in your favor. Now, one thing you can see is, do you see another from this way that this fly shape works? Do you see how that after a couple days, even if you blow outside of the tent, that this particular type of fly is still at least breaking even? Pretty long range, right? So this was a fly. One of my pro guys said, hey, wow, these are looking pretty good. I looked it up. I go, ship, they sure are. And the market isn't going to do anything. Again, lower realized vol, market backing off a little bit. We can't get past 3,000. And it's just an ideal situation for a trade like this. Now, there are other ways to manage it. You could buy multiple flies and buy a call and kind of hedge the delta a little bit in case it flies up. So we can't, I'm not really going to talk about, you know, management because we don't have the time for it. But the idea is when you're using the sheet, it is helping you see where the edge is, where the market is bidding something, and you know what your risk reward is. So it's giving you a lot of information that when you just look at a regular option screen, you're just not going to see. Right? And if you want high decaying trades, what I would call accelerated trades, where you have many things working in your favor, it's a much faster, efficient, more efficient way to do something. Right? Because if I don't really see any edge or the flies don't look great, I just know I don't have any interest in selling vol today. Like that fly is just not the trade. I got to go look for something else. Okay. So, summary. delta neutral fly. So in order to make money besides delta, you need something else. You're using skew, you're using Vega, you're using decay. The vol conditions and the curve shape play a huge role in picking your entry. You can quantify your edge, right? You can change the strikes and move things around. And then you have a plan, meaning I think this underlying is going to go from here to here. What's the best fly to affect that? All right. So the sheet is just a way of helping you look at the market in a very narrow way. So we have sheets for time spreads, and we have sheets for buying vol and selling vol, and I have a whole suite of vol product sheets, all kinds of stuff. If you're interested, if you're a toss person, send me a note, andrew@optionpit.com. We can talk about something. You can try out a toss sheet. It's not as good as this one, but it works. It's better than nothing. All right. So here you go. If you don't have any sheets, you don't have anything, what I do is we give you 2 hours of instruction with the sheet. So you got to learn how to do it. Also, we have master class, your Edge Hunter butterfly sheet. A month of Option Pit Live and Vol newsletter, all kinds of stuff. And our butterfly intensive course, it's $9.97. So you get the sheet. Now, for this sheet, you have to have a subscription to LiveVol, which is $250 a month, which is as cheap as you can get it from anywhere. So if you are what I would call an active trader, it works. We have about 29, 30, maybe 32 or 33 people in Option Pit with LiveVol subscriptions through us, so they get a good deal. If you don't want LiveVol, I think the toss sheet could work. We could work something out. But generally, I sell the sheets with instructions. Total Allen, there's what I would call, there's four flights of sheets. There's so you've got flies and the curve sheet, which is the skew sheet, time spread sheets, vol buy sell sheet, and the volatility sheet. So there's 4 sets of sheets. So if you're interested in them, let me know. We certainly will, we can do something. The guys that have them like them a lot. They're mostly very active. I basically just use those all day. I don't even look at anything else anymore. Do they come with a pro subscription? If you talk to Mark nicely, you could probably get a really good deal on them. Let's put it that way, Mike P. So if you're interested, send me a note. Because once you want to do a pro subscription, we can wheel and deal on a couple of things for sure. All right. So here's a tricky question. Assume I start with 2 flies, 0 delta. So the unbalanced fly will work better, Petru. That has generally less delta, but a standard butterfly has a shorter delta in it. So you really have to define like what your delta is. If you're saying 0 delta, a broken wing fly will not do as well. Because the broken wing flies are short the most gamma. The unbalanced fly actually has the best risk reward profile. So there's a regular fly, a broken fly, and an unbalanced fly. So his question is, if I start with 2 flies, 0 delta in the SPX, a regular and a broken fly, which one makes more money if the VIX drops? And which one loses money if the VIX goes up 1%? So I would say your standard fly will do better. The broken wing fly is short more gamma though. Nope, the flies show unbalanced and standard flies, Bo. So what you do here is you can actually go down, and this is the thing I like, one of the things I like the most about it, is you go down the whole suite of flies and you see how cheapy these little flies get. So here you're looking at a 3,000, 2980, 2960, and you go all the way down. So it can show you where, if there's any edge in any of the downside stuff. Because sometimes just a standard fly is best. Right? Generally, those are the ones where you're really trying to pin a strike or somewhere around expiration. That's when this has shown the best use. Like 2 to 3 days before expiration, and the market just is bidding the crap out of one at the money. Any more questions? So, Alan, what I would use the sheet instead of for the iron condor, I use like the vol buy sell sheet for iron condors. And the reason is that's really just a because an iron condor, when if I teach you like as a strategy, it's really a short delta strategy. An iron condor, you have a bit of a short delta. So you're mostly looking for when is a good time just to sell vol in general, if that makes sense. This is really trying to press two strikes against another to try to squeeze the most money out. And iron condor is more just, so the VBS sheet is better for the iron condor. You just put SPX up and then see if there's anything to sell the options. These sheets are equity and index. Unfortunately, LiveVol does not have an execution platform attached to it right now. I think they are saying Silex, but it's very expensive. Okay. That's just the way it is right now. Down the road, it will improve for us, but it's just not there yet as far as just the reality is data is data. It's expensive. Also, and what this does is this sets up a fly based on the straddle, and it shows you already the best 1, 2, 3 fly for the straddle width and the risk reward. So as far as the nitty gritty of fly setup, Petru, that I just would have to do that in another class or something with you. Because once you start moving outside the straddle for your fly width, unless there's a lot of edge, your diminishing returns are pretty fast. Like the risk reward profile gets all out of whack. Doesn't mean you can't make money, it's just your changes the risk reward profile. This is SPX. This is one, there's more features. This is one about pitchforks. This is a whole other thing about ways to sell vol. I think, Alan, you had your question. This is another part of the sheet where you could use for iron condor when you have this is when like the 25 delta options are really bid. So we could talk about that in a session and I'll explain it to you, but you would use this part of the sheet for that as well. Because that basically means that the wings are super expensive. So this is a better time. Okay. And this one here, it's like, so you see something you think's expensive, you hit the button, and it takes you right to the spot in the term. Like, oh, okay, well, I want to sell that. So if you want more in-depth, more questions, you want 30 minutes, Right? You go here, you go load, you go up. This is trading at 116% of one standard deviation, and these are jacked. Right? So right now, well, the SEP 27, it's expiring tomorrow. Right. Let me see where it's taking me to. Like that. All right, everybody. Have a good night. Thank you for coming. If you have questions, anything you want to purchase from us, send me a note at andrew@optionpit.com. And we will see you later.